That is bonds, of course. Then we'll come back to cars. Andrew Brenner is back with us, head of international fixed income securities at Natalliance. Andy, good to have you back on the show. We had to get you for a little emergency wrap on the week, given that the last time you and I talked, and for a while now, the warning signs that you've laid out that yields can move quite quickly in this environment. So what do you make of the action this week? Is that it? Did we get it out of our system, or is there more to come?
Absolutely more to come, Oliver. As much as it looks like it was an exhaustion move yesterday, as I continue to look at things, I think you're going to have a total reversal of thought. I think that given the way the Fed responded to higher rates, saying higher rates are good, we're not worried about higher rates, it starts to question the credibility. Is the Fed still all in? You know, given how we moved last year and you know, with the close downs and COVID and the dropping of the second quarter GDP of 35 or 40%, the Fed did go all in. We were 100% behind them. They stabilized markets rallied. Now I'm starting to wonder if the reverse is going to happen. You know, the Fed is letting interest rates rise. They're not steady. They're not stepping in at all. I mean, you saw that horrible 7-year auction yesterday where it was a 4.5 basis point tail. The 10-year went from 147 to 161, the 5-year at 86. The better performer was the long bond that stayed inside of 240. And now we have a little bit of reallocation at the end of the month here, where bonds have a little bit of a bid today, and stocks are pretty mixed. Obviously, you've been talking about it. The S&P is flattish, the Dow getting hit, and the NASDAQ doing quite well. But I don't think any of it's over. You know, I mean, you talk about support levels, resistance levels, so on and so forth. We think 10 years have support at 167, but we would not be surprised to see a 195 to 2% on the 10-year. I have no idea where we'll be at the end of the year, but I think we have the potential to go much higher in rates. We've got $4 trillion of stimulus. You've got a Fed that doesn't seem that supportive. You've got a Fed that is getting questioning credibility. I think that's why they're bringing out Powell again next week. You have the ECB, who is quote unquote looking at nominal rates but doing nothing about it as their rate market goes back. The Fed has to redevelop their credibility. And right now, after this week and all the Fed speeches, we think that credibility is a bit waning.
So, Andy, there's a lot here to unpack, but I want to start with that because we do have limited time, but I want to try and get through a few things here. The one that maybe is most important is how the bond market will respond to Jay Powell's language. I've been making the case here that there's almost this backwards relationship where the more dovish Powell gets, it's like yields keep moving even farther, because even though he's not going to hike rates, there is a more increasingly high probability with which investors can assume we're going to get inflation, right? Because the more he promises not to hike, then the more certain we can be that inflation's going to get here eventually. And it's not just going to be one prayer, right? Because he's got to let it go for a little bit. So if he comes out and he says, hey, look, guys, we're really, really not going to hike. I mean, is that just going to make the sell-off worse? Am I crazy? Is that possible?
I don't know that it's going to make the sell-off worse, but what it's, well, you know, maybe it will make the sell-off worse. One of the things the Fed doesn't control are long interest rates. And as the inflation expectations continue to increase, as you see it at a variety of things, the Fed can use the words transitory and disinflation for many years as long as they want. But for right now, Oliver, I'm not so sure it's about inflation. I think it's about $4 trillion of stimulus, of $4 trillion of additional bonds. And I think it has to do with the fact that you know, interest rates, there is no liquidity in the marketplace. I mean, even now, just to make things worse, the Fed is talking about not renewing the SLR, the supplementary leverage ratios for banks, at the end of the month. That's 30 days away. And you're trying to tell me you're going to restrict banks from buying treasuries, and you're seeing the worst liquidity you've seen in treasuries since last February and March? Come on. This market has got a lot of problems in it, and I think it can gap anywhere it wants to go, and the curve will get significantly steeper.
Okay, hold on. Say the last part again, Andy. What's the part about banks and the restrictions to buying treasuries?
Carl got multiple questions on Tuesday and Wednesday from first the Senate and then the House. The supplemental reserve ratio, supplemental leverage ratio, which the Fed suspended in May of last year, had curtailed banks' ability to buy treasuries.
Yes.
That restriction was removed temporarily, and it goes back into effect April 1st. the Fed is thinking about having it removed. This will restrict banks. It will make it more difficult for banks to put treasuries on their balance sheet without having some negative effects on them. And that will just make the liquidity in this market even worse.
Well, that potentially,
and that's what people are thinking right now.
That potentially removes a buyer when bonds look like they need a buyer right now.
Oliver, bonds need a buyer like you wouldn't believe. I mean, I just quoted you the $4 trillion. Yellen's going to stuff the market with Biden's going to come up with all this stimulus. I think it might be a little bit too much, but I would like to see an infrastructure program. But the only way they're paying for it, they're not raising taxes right away. They're going to pay for it issuing treasuries. And, you know, in issuing that kind of treasuries, there will be demand, but you need to have all the buyers lined up. You can't have just part of them. You can't remove banks. Not now.
So, Andy, I want to come to another thing here. To your point about trying to assess whether or not this is supply and Fed dynamics versus just the market repricing around reflation, I think this is super important. I don't have the chart ready, and actually my colleague Joe Weisenthal just put it out. I can see that it comes from Goldman Sachs. So it's a Goldman Sachs chart that shows this week's move in real yields on a 2-week basis compared to previous instances, and the degree to which we move the velocity is closer to the 2013 taper tantrum, above the 2015 Bund tantrum, way above the 2016 reflation theme. So to your point, one would use that as evidence to argue this is more about supply and policy dynamics than a reflation theme, which is very different, right?
I think it's very different. And I also think you have to add in the liquidity aspect or the lack thereof. You know, I mean, Oliver, you're having more massive supply than you can imagine. I mean, yesterday's 7-year auction, a year ago, that 7-year auction was $32 billion. Yesterday was $60 billion. I mean, come on, these are big numbers, and it's across the whole curve. So you really need to have buyers, and you really need more liquidity, and you don't have it right now. And the Fed is not saying anything about additional QE, and it's not saying anything about twisting, you know, buying the long end of the curve. So
is that coming, Andy? Just real quick?
Quote unquote, they're happy about rates rising. We got a problem.
Andy, real quick, yield curve control, you think that happens this year?
No.